Selling cash-secured puts on stocks an investor is happy to take ownership of is a great way to generate some extra income. A cash-secured put involves writing an at-the-money or out-of-the-money put option and simultaneously setting aside enough cash to buy the stock. The goal is to either have the put expire worthless and keep the premium, or to be assigned and acquire the stock below the current price. It's important that anyone selling puts understands that they may be assigned 100 shares at the strike price. Why trade cash-secured puts? Selling cash-secured puts is a bullish trade but slightly less bullish than outright stock ownership. If the investor was strongly bullish, they would prefer to look at strategies like a long call, a bull call spread, or a poor man's covered call. Investors would sell a put on a stock they think will stay flat, rise slightly, or at worst not drop too much. Cash-secured put sellers set aside enough capital to purchase the shares and are happy to take ownership of the stock if called upon to do so by the put buyer. Naked put sellers, on the other hand, have no intention of taking ownership of the stock and are purely looking to generate premium from option selling strategies. The more bullish the cash-secure put investor is, the closer they should sell the put to the current stock price. This will generate the most amount of premium and also increase the chances of the put being assigned. Selling deep out of the money puts generates the smallest amount of premium and is less likely to see the put assigned. CVX cash secure put example. Yesterday, with CVX trading at 173.89, the May put option with a strike price of 170 was trading around $5.10. Traders selling this put would receive $510 in option premium. In return for receiving this premium, they have an obligation to buy 100 shares of CVX for $170. By May 20th, if CVX is trading for $150 or $120 or even $80, the put seller still has to buy 100 shares at $170. But, if CVX is trading above $170, the put option expires worthless, and the trader keeps the $510 option premium. The net capital at risk is equal to the strike price of 170, less the 5.10 in option premium. So, if assigned, the net cost basis will be $164.90. That's not bad for a stock currently trading at $173.89. That's a 5.17% discount from the price it was trading yesterday. If CVX stays above $170, the return on capital is $510/$164.90 equals 3.09% in 31 days, which works out to 36.42% annualized. Either the put seller achieves an 36.42% annualized return or gets to buy a high-yielding stock for a 5.17% discount. You can find other ideas like this using the naked put screener. Below you can see some parameters that you might consider for running this screener. Feel free to tweak them as you see fit. Company details. The opinion rating is an 100% buy with the strongest short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. The market is in highly overbought territory. Beware of a trend reversal. Of 15 analysts covering CVX, 9 have a strong buy rating, 2 have a moderate buy, 3 have a hold rating and 1 has a sell rating. Chevron Corporation is one of the world's leading integrated energy companies. Through its subsidiaries that conduct business worldwide, the company is involved in virtually every facet of the energy industry. Chevron explores for, produces and transports crude oil and natural gas, refines, markets and distributes transportation fuels and lubricants, manufactures and sells petrochemicals and additives, generates power, and develops and deploys technologies that enhance business value in every aspect of the company's operations. Summary. While this type of strategy requires a lot of capital, it is a great way to generate an income from stocks you want to own. If you end up being assigned, you can sit back and collect the nice 3.31% dividend on offer from CVX. You can do this on other stocks as well, but remember to start small until you understand a bit more about how this all works. Risk-averse traders might consider buying an out-of-the-money put to protect the downside.